So on one hand, we've been facing this high inflation. However, we haven't really felt the full pain of this inflation because people have had the ability to spend. Why have they had the ability to spend and pay higher prices? Well, thanks to the pandemic, all the excess and free money that was printed and sent out is still out there. Now, what JP Morgan Chase Bank is predicting is that by the end of 2023 or middle to end of 2023, we're going to run out of this excess cash. But we still have this high inflation. I mean, the inflation hasn't gone away. Maybe it has cooled down, which means the price of things are still growing very quickly, but they're not growing as fast as they were before. Unless we see negative inflation, which would be deflation, we're not seeing the price of things fall. So we're still seeing the price of things grow very quickly, while people's savings are dropping very quickly. And then once people's savings die, they go away, now people have to pay for the high prices of things, which will be higher in 9 months than they are now. Even though it might not grow as fast as it was growing a couple of years ago, it's still growing very quickly, but then people will have less ability to spend. So you have people's ability to buy things falling very quickly, while the prices of things are rising, not as fast as they were, but still rising very fast. This is the first inflationary problem that the Federal Reserve Bank is worried about, that they're trying to bring inflation down. How are they doing that? By trying to reduce the demand by increasing the price and cost of things. They're working to increase interest rates to bring inflation down, because this high inflation, as soon as people run out of this money, is really going to start hurting more people, because now you have people that have no savings, that don't have the ability to spend, while the prices of things are still extremely high. The second thing that the Federal Reserve Bank is worried about is the stock market and the real estate market falling. Not because they're worried about the prices of stocks and real estate, but because of what that might signify going forward. Now, if you do want to stay up to date on what's happening, when it's happening, then you should join something like Market Briefs. Market Briefs is my free financial newsletter where every day my team is breaking down what's happening in the housing market, the stock market, the crypto market, inflation, and the global economy. It's a super fun and easy to read email. You can read it in less than 5 minutes every morning and is completely free. So if you haven't joined Market Briefs yet and you want to stay up to date on what's happening in the markets, I'll put the link to how you can join Market Briefs down in the description below. The Federal Reserve Bank has been working to raise interest rates to bring inflation down, and the effect of higher interest rates is, not surprisingly, that it's more expensive to borrow money. And when it's more expensive to borrow money, that hurts businesses, meaning the stock market, and that also hurts the housing market and the real estate market because, well, it's more expensive to borrow money. But the real concern isn't really just that stock prices or real estate prices might fall because of higher interest rates. It's what might happen because stock prices and real estate prices are falling, especially when you consider the fact that we have the highest amount of debt ever right now. Let me show you what I mean. Let's assume that you bought this home for $200,000 and you decided to put down 10%, which is actually higher than what the average down payment has been over the last couple of years, because over the last 18 months or so, the average down payment has only been about 6%. So if you put down 2%, that means you put down $20,000 and you financed $180,000 of debt. Now, if a year from now, the home value goes up to $300,000, what does that mean? Well, for the average American, what that means is now you can go to the bank, you can refinance some cash out, pull out another $50,000, $60,000, $70,000, put it in your pocket, and now you can go out and buy a boat, buy a vacation, buy something else. It's good for the economy, not good for you, not something that I would recommend. But what happens now if home prices fell? Not to, let's say, $180,000, but what if they fall to $160,000, where now you were underwater on your home? Well, it's really not that big of a deal. Sure, now you can't go out and refinance and go out and buy a boat, but if you have the ability to continue making your payments, now that's really not a big deal. Yeah, you're underwater. The economy might not boost because you can't go out and buy the boat and all the nice stuff, but everything is fine because you still have your job. You can still make your payments, so it's not a big deal. But if you lose your income, if the economy slows, I'm going to talk about the economy in just a little bit, but if the economy slows and you lose the ability to continue making your debt payments and now you're underwater, that's when the debt becomes a problem. Too much debt is not a problem until it becomes a problem, and too much debt can become a problem when you lose the ability to make the payments on your debt. Because now if you're underwater, you can't refinance because no bank is going to want to refinance you when you owe more than what the home is worth. And you're not going to be able to sell, because if you wanted to sell this $160,000 home, well, you're going to have to bring $20,000 to the closing table. Maybe you pay down 10 grand, but you still got to pay a lot of money at the closing table in order to sell this home. So now you're stuck. Now instead of mailing in your mortgage payment, you're going to have to mail in your keys. This is what the worry is. Because if this starts to happen and now people are underwater and they lose their income, that could cause an even bigger problem in asset prices. That's what could turn a correction into a bigger crash because people lose the ability to pay, and now you start to have involuntary sales of assets, whether it's stocks, whether it's real estate, because now people are being forced to sell not because they want to, but because their lender is saying that you have to sell because you lose the ability to pay. In the stock market over the last couple of years, we have seen this big boom of margin trading, which is people trading and investing their money on debt given to you by a stock brokerage. Now, I don't recommend you do this, but over the last couple of years, because interest rates have been so low, we have seen this huge boom in margin trading. This is directly from the FINRA website, and what you see is that towards the end of 2022, we had about $643 billion in outstanding margin debt in the stock market. While this is lower than our peak during the pandemic, it is at pretty much the highest levels that we've ever seen even before the pandemic. We have more outstanding margin stock market debt today than pretty much any time before the pandemic, except maybe a few months in 2018. But besides those few months, we have more margin debt today than ever before, while the interest rates are rising very quickly, while we've been seeing stock prices in general fall. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.